you have to be willing and able to reevaluate. For a very long time, our portfolio has been relatively stable, but we've also been in a relatively tight band of regime, largely driven by interest rates. I would say that interest rates are probably the primary factor that would change all of the potential to make change. And that's something that's been said internally in our organization for many years is if we were to go back tomorrow to an interest rate period where, interest rates are 8%, that's going to have really different longer term 10-year implications for asset classes. So I think the way that we try and build it is there's no portfolio that can be built on a permanent basis. That said, unless there's strong reason to believe that the regime has actually shifted, you really need to kind of stick to it.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Larsen.
For me, the best part of my podcasting journey has been the opportunity to speak to a huge range of extraordinary investors from all around the world. In this series, I have invited one of them, namely Alan Dunn, to host a series of in-depth conversations on the topic of what it takes to be a world-class allocator. In today's world, portfolio construction is fast moving to the top of the agenda of many investors as they try to analyze and understand the riskiness of their portfolios. And with ever-increasing uncertainty around the globe, being well diversified across many different strategies and themes in your portfolio can mean the difference between ruin and survival when the next crisis emerge. The aim of these conversations is to try and understand the experiences that have influenced these highly specialized allocators and the processes they follow to harness the best returns for their clients so that we can all become better informed investors. And with that, please welcome Alan Dunn.
Thanks very much for that introduction, Niels. And I'm delighted today to be joined by Jason Morrow. Jason is Deputy Chief Investment Officer with Utah Retirement Systems. Utah Retirement Systems manage $54 billion in retirement assets. And as Deputy CIO, Jason helps direct all aspects of URS's investment activity. Jason, great to have you on the podcast today. How are you today?
Hi, Alan. Great to be here. I'm doing well. Thanks for having me.
Good stuff. Well, thanks for taking the time to come on and chat to us. As is typically the case, we like to ask people just to give a little bit of background on their journey in the financial markets and the investing world. So what was your path to becoming a Deputy CIO at Utah Retirement Systems?
Serendipitous for sure. If we're talking the whole journey, and we often ask managers and other investors to tell us their long story. I won't do that, but typically often find you can learn a lot from managers going back a long ways and sort of understanding their motivations and their why they're in the industry. I think for myself, at a really young age, I was introduced to this concept of compound interest. In fact, my grandfather, who had been a banker at one point in time, had said, he looked at me and he said, kid, those who understand interest earn it and those who don't pay it. He called everybody kid. But that phrase sort of resonated somehow at a pretty young age and bounced around and rattled around in my head, still does to this day. And so interestingly, as a teenager, I was the oddball that would write to mutual fund companies and request their prospectuses and sort of seek to understand what it was they were doing, how they were doing it. That would have been in the mid-90s. And back then, Reg FD didn't exist in the US at that point, and active equity management was still a thing. Fast forward from there, put myself through undergraduate and grad school working for a subsidiary of United Health Group that was focused on healthcare information systems and data, and knew that I wanted to move into an investment role. That had been my goal since probably since a teenager. The markets are an ever evolving puzzle, and I think learning is a strong strength of mine. And what better place to do it? What better type of field? I didn't know that the term allocator existed back then, and as most thinking about it those days are focused on picking stocks. That's the most common thing people do. So I went to school and found the classes that had investments as a topic, and studied finance. In retrospect, I wish I would have studied other fields, but I studied finance, and ultimately in grad school I found myself working for what's known locally here as the University Venture Fund, which is a program that combines students that have an actual fund of their own pool of capital. And we invested alongside venture capitalists throughout the country. So that was a really interesting experience, and I learned a ton. In fact, I remember often having the opportunity to go to board meetings and thinking I'm learning a lot more here than I am at school. So this is a far more interesting place to be. And then ultimately from there, a colleague at the venture fund tapped me one day and said, "Did you know there's a $20 billion plan down the street building out alternatives programs? We should apply." And so we did. I originally took the role thinking this would be a good springboard, but into the industry, but ultimately have since come to immensely value the impact we have on our local community, and sort of that combination of professional investing and public service that comes from working for a pension fund. I never valued that until the first time I randomly walked up to a policeman in a grocery store and said, "Hi, my name is Jason. I work for the retirement systems. What's your name?" I immediately had a new best friend. And that experience was really rewarding. So I joined URS in 2007 to begin, as they had already been a couple of years into a hedge fund program. I didn't have background in hedge funds or anything, just, sort of an eager person out of grad school. But I learned it really quickly. And I think in the compression time that was the great financial crisis, picked up somewhere between 5 and 10 years of additional experience in the course of about 24 months. So that was the beginning of my journey. I think as an individual, I'm naturally very intellectually curious. I love to learn. I love to analyze. I love to deliberate the pros and cons, to evaluate upside, downside, and the probabilities. And so it's been a great fit, and I really enjoy that.
Very good. Yeah. So it's obviously a very interesting seat. You're looking at a huge portfolio of $50 billion plus. Just to set the stage for the conversation around kind of your approach to asset allocation, etc., are there any particular constraints, or what are the objectives? Obviously, it's a pension plan, which maybe is run with the objective of I guess, fulfilling the liability side. But from your perspective, how would you describe the investment objective and any constraints that are on the portfolio? Well,
the two pools of capital we oversee, the pension is about $44 billion, and the defined contribution is $9 billion. That's 401k and other type assets. So let's focus on the pension side, which has the more sort of, I think, modern approach to asset allocation, and has for a long time. The primary objective is a 4.35% real rate of return. So we strive to achieve a 6.85 bogey, and the inflation assumption has been 2.5. I know that, we will at some point undergo an asset liability study and press refresh on that inflation assumption. I think if you look at the current situation, it seems low. And if you look at the forward markets and what markets seem to be pricing in, TBD on where that inflation assumption comes out. The primary constraint, I would say, for us is back in the dot-com bubble, Utah Retirement Systems has always been forward thinking in terms of asset allocation and seeking additional sources of potential return and diversification. And there we had, I wasn't there at the time, but I can see the legacy that the dot-com had as an influence on the plan. And sometime after that, there's language in our investment policy statement that says, as a primary objective, we will strive to achieve diversification due to the volatility of public equity. Well, now, why does the volatility of public equity matter? Well, as a pension, there are 488 different state entities that participate in the pension system. And volatility in plan assets has a direct connection to the volatility in their budgets. And obviously the worst time to call and ask and say we need higher contributions is in a contraction or in a down market or in a period of recession. And so our primary constraint tends to be, and I'd say the friction between the return and the risk objectives, because they're sort of opposite. You have to take enough risk to generate the return, but if you take too much risk, you can really move those returns around, and then those have downstream flows to all these entities. So our primary constraint is more of a, how do you achieve the return objective while also maintaining a vol level that doesn't mess with a state's budget? And so when we think about the risk constraint, the primary risk constraint is to moderate volatility, but still take enough risk to achieve the goal.
And I mean, could you say, in broad terms, what would the overall portfolio look like in terms of realized vol over time?
Oh, goodness, realized vol over time. I think we model it in somewhere between 13 and 15, which sounds like, relatively reasonable. On a realized basis, it's been strikingly lower than that. And I think part of that is the interplay in terms that, some alternatives in illiquids have lower marks. We don't give them any credit for that. It's a very hollow victory because the performance eventually comes through, and you can't really sort of say, oh, well, it doesn't get marked, so it's going to lower the vol. That's going to bite you at the wrong time. So, but I think on a realized basis, ours has been quite a bit lower. When we look at reports that come from our consultant on a risk adjusted basis, we have amongst the lowest volatility in the entire nation. And I think a large portion of the purpose for that is because the volatility of assets has implications for terminal wealth down the road. The more vol, the bigger the range of outcomes, especially if you have liabilities you pay along the way. Dollars and money that draws down but has the potential to recover can be value added. Dollars and money that draws down that then gets spent is money lost.
Right. So, to sum up, you're saying you want to take enough risk, obviously, to meet your liabilities, but you don't, notwithstanding being a kind of a long-term investor, you don't want to have too much volatility month to month, year to year, because of the implications it can have in terms of calling more capital. So you're trying to balance that, and it comes out at running a portfolio at a little bit under kind of public equity market index vol. It's a fair assumption, is that right?
Yeah, and I think that along those same lines, it's interesting because, when you first get into the industry, you sort of have a total return mentality, but you have to adapt to your client's needs. And so, as a pension, we are definitely return seeking, but not total return. If there's a way to save some risk and achieve the same return, we're likely to take that path.
Yeah. Okay. You touched on the kind of return objectives and the assumptions, the 4.35% real, 2.5% inflation assumption, which, as you say, obviously we're in a higher inflation environment at the moment, but maybe if you look at, I guess, 10-year break-evens, probably in a kind of similar range. I guess inflation's pretty important to a pension plan. It influences, obviously, the liability side. In an environment like we've had this year, where inflation has been higher than many people had expected going back 12 months, does that cause you a lot of headaches? Does that cause you to kind of re-examine the portfolio, or has the portfolio been always kind of constructed with the perspective that at some point we may get an overshoot in inflation?
We skew more to the latter of trying to always have some form. That the challenge at $44 billion is with a lot of illiquids and alts, you can't move that around all that quickly. So you have to think in terms of longer term. And when we construct the portfolio, we do start with a traditional mean variance framework, and we overlay some judgment and assumptions on top of that. But the next thing that we certainly do is we also consider different types of regimes. And in a simplistic approach to regimes, you can have basically either a growth / non-growth environment or inflation / non-inflation environment. The last 40 years has largely been in that relatively decent or strong growth and either declining or modest inflation. That is the absolute best. In fact, I think we've got some history on it. It's something like 78% of the time, year to year, that is the environment. And so most portfolios are appropriately kind of built towards that. And I think long term, you also have to think in terms of that structure, because the market returns tend to be skewed, skew's the wrong statistical term, but they tend to be right of zero, right? So on balance, the market overall and over the long term is up. And when we look at those dimensions, you can overlay different types of assets into those different quadrants of growth, recession, low/high inflation. And we have long felt that as a pension fund, inflation is always your enemy in the near term. In the long term, ownership of equity assets tends to flow through. And the best quote unquote hedge for inflation is just the equity ownership of economically viable assets that create value for society. And long term, that's what you should own. However, in the near term, your liabilities unfortunately don't take a holiday. They don't take time off. Yeah. They are consistent, persistent, and relatively stable and linear. So we have, since 1981, have had an allocation to a real assets portfolio in real estate. So we've always had an element. I think in the near term, we looked recently at our performance and we're sort of surprised at Q2 because of where our performance is. But we also have we have some assets in our real asset portfolio that have a lot of upside asymmetry to inflationary environments, and they've been performing. So, the book, it's hard to manage, because when you put together those different environments in those four quadrants and say, overlay them with assets, the problem is you're not really built to outperform in any of the specific environments. So on a year-to-year basis, you're always sort of looking at it and going, well, we didn't outperform this year, but for us, we then shift and most of our reporting starts with what's the 10-year number. I think there's a huge amount of investor psychology in terms of just the way you read things. You can set expectations. So if your board reports or your performance reports start with the most recent quarter, and that's on the left side of the sheet, that's where people are going to start talking. Ours are skewed to the right side so that we can take a longer term view and default the conversation with starting long term. Don't start with the short term. Short term is mostly noise, and long term is where the noise gets ironed out.
And I'm curious, you touch on the different regimes, and a lot of the conversation we have on this podcast is, the possible shift in the macro regime, and nobody knows. And even, you get 1 month of CPI that's a little bit better than expected, and everybody is convinced that the inflation scare is over, etc. And but I guess as an asset allocator, as you say, you have to manage for different scenarios, different regimes. If we had, kind of the not quite the doomsday, but certainly the more challenging environment of higher inflation, or persistently high inflation and persistently, say, disappointing growth and equity returns being, flat to negative, or at least in real terms, over, say, a decade or something like that, would that prove very challenging, or would that be something that's still manageable via your diversification, or would that, if that became apparent over time that we were in that regime, that would prompt any kind of more significant change in the approach?
I think in that type of a more structural, persistent, we'd have to reset to some degree. I think everyone would, because that's the one quadrant that, ironically, cash and gold work very well in that quadrant, and they often don't work in any of the others. So you'd have to press refresh. I think in the near term, we don't move quickly by design, and in the near term, like we would be okay. Our outflows are relatively modest as a pension. We're in the I think enviable position of being nearly fully funded and have relatively modest outflows. So, and that's largely a function of sort of governance and structure and forward thinking. And I think that those are key to sort of setting up for success. But for sure, if we move into an environment of, even slightly higher inflation, I think the market celebrated the lack of another uptick, which is, and I think, let's get 2 or 3 months of those types of data points. I think one is a nice data point, but in markets, I'm always sort of worried about the head fake that happens so often, where you get 1 month and then, that's the outlier. The trend then continues. So we'd want to see a continuation of that before we get too celebratory. But if it stays higher, inflation at 5, 6, 7, that's a pretty powerful compounding erosion of purchasing power. I think in our portfolio for the near term, we have a lot of assets that are dramatically skewed to that. And, well, not a lot. I mean, it's not an immaterial portion, and the asymmetry of capture has been compelling.
Okay, so I mean, talk to us a bit about that in terms of the asset allocation mix. So I guess you're trying to build a portfolio that has enough risk, but equally has volatility dampeners in there, and equally has assets and strategies that can help you out in an inflationary environment. So you're kind of trying to balance the portfolio for different scenarios. So what does that come out at then in terms of an asset allocation profile?
So the asset allocation, I used to describe it sort of as a 40-20-40, being 40% global equities, which really exists to capture that participation in growth, and public equities. Public equities are the largest portion of our asset allocation, but it's still relatively modest at 37%. Coupled with private equity, we get, which is a 12% target, we get closer to kind of a 50% equity mix, and then a 50% of other types of assets. Many of which do have equity-like profiles. They're just not in traditional equity markets. So a 40-20-40, I think today we're actually closer to 37-20-43, and next in line after the allocation to equities is investment grade fixed income. The purpose of that portfolio, if you look back historically, investment grade it was small, but it still had a positive real rate of return relative to similar duration treasuries. And so while always a bit of a drag, the nice thing about investment grade fixed income is it provides a lot of options for you. And so the other portion of our portfolio is split between real assets, private equity, and absolute return, which are diversifying and hedged strategies. And that investment grade portfolio serves to provide liquidity to pay out benefits, but it also feeds the other two portfolios in periods of downturn or correction or drawdown, things like that. And then, we have an active rebalancing program, try to be far more systematic than not. And then on top of that, we do have a couple of really marginal tactical tilts that are not discretionary. They're programmatic. When certain, when credit spreads hit a certain level, we can turn on a buying program, and some things like that. So high level, the purpose of the alternatives in the 40-20-40 approach is additional sources of return that are not available in traditional markets, and also additional sources of diversification not available through traditional markets.
Okay, so a couple of points to pick up there. One, obviously you're maintaining kind of a 20% exposure to fixed income investment grade bonds. Has that come down over time as yields have come down, or has that kind of been fairly stable over the last number of years? A lot of people kind of had been calling for the end of the 60-40, obviously, or not 60-40, but people when yields got really compressed, obviously on a kind of on a forward-looking basis, returns looked more challenging. Or is it something that you always keep for that kind of diversifying element and that income generation? Or how do you think about fixed income, I guess, in the portfolio?
We have maintained the strategic target at 20. The mix of it has changed a little bit over time. If you go back a number of years, I mean, that 20 includes linkers, it includes global, because there are so many curves globally that you can create some additional diversification. So both our public equity and public fixed income are on a more global basis. But broadly speaking, the fixed income portfolio is a keep it simple, don't get too clever. Don't add unintentional equity beta or other things with high sensitivity, because you need that portfolio to do its job at the right time, which is, when public markets decrease in value or other assets decrease, you need it to be liquid, A, and second, have not lost, have not lost its value.
Yeah, and you touched on equities, public equities, just under 40%, and then private equity, say 11%. And there's been this tremendous growth in privates over the last couple of decades now, and you've mentioned, Utah were an early stage investor in private equity. I guess some investors have maybe taken it to even a greater extreme in terms of the public-private balance. How do you think about what's the appropriate mix there between public and private? And I suppose one of the other question that we get, or we think about sometimes as non kind of private equity experts, looking at it from the outside in, there's often this perception that, it's less, people think it's because it's not marked as frequently, it's kind of okay, safer place to be almost, even though not really. Is that, are those that less frequent marks? Does that impact your thinking? Is that beneficial in any way? Or, what's your overall way of kind of assessing the merits of public and private in the equity space?
Wow, that's a lot we can dig into. But let me start with kind of at the top. I think the challenge of private equity is similar to challenges across, and by challenge I mean implementation, across other alternative assets, wherein public market dispersion across strategies is relatively tight. There's a reference pool of assets in the index that you can go replicate if you seek to do so. So, the choice of implementation on public markets is generally a bit more philosophical. Do we believe in active? Is there merit to active? Do we believe more in indexing? I won't necessarily call it passive because every index has its own strategy. It's just very consistent in how it's applied. So indexing versus active, should we just take the low cost approach for indexing? And effectively all alternatives don't work like that. There is no reference pool of assets you can go replicate. There is no accessible statistical profile you can just go buy and add to your portfolio. For sure, there have been a lot of replication approaches. They tend to be inferior. And private equity is no different. I think that there are a lot of tailwinds to private equity, however, not just from capital raised, but the number of public securities, tailwinds and advantages. The number of public securities, especially in the US, has decreased dramatically. Many companies are choosing to stay private for far longer because the ecosystem in private equity has evolved to where you don't necessarily need to go public to sort of move to that next stage. Additionally, private companies have, I think, far more tools as far as governance to be able to do the right thing. I mean, if one of the greatest books that I really enjoyed in the past 12 months was reading Michael Dell's biography, and he talks about this very interesting pivot he had to make with his internal team and getting them to not be focused on how the public market was going to view certain changes. And, this ability to take a longer term view was really game changing for them. And it's interesting. Private equity, I think it's not a question of, you asked the question is, how do you think about the mix? And I think some of the factors that matter most are your size and your access. Unfortunately, one of the keys to having a very successful private equity program starts with already having a very successful private equity program. It's not an asset class that you can just go say, let's add this and we'll do exceptionally well. The great managers who have been around for quite a while have exceptionally long wait lists and they pick their clients. And so, private equity, I think if you're building your mean variance or your construction right, you should absolutely apply a much higher level of volatility to it than public equity. That said, I think one could argue that private markets don't value things enough. And on the other side, it could be argued public markets tend to overdo it. So the balance between the two tends to probably get closer to reality. And at least in our case, we're big enough to matter to our partners, but not so big that we can't still do unique and interesting things.
Okay. So it sounds like implementation pretty important in terms of that. And I know that's one of the messages that comes out in relation to the much kind of discussed Yale model of it's not just about asset allocation. I guess it's about, access as well. Is that a fair description, or is that something you would look at as something that is, you would like that you think it's something to replicate, or is there something unique about the Yale and Swenson approach that was specific to them that other investors won't necessarily be able to replicate?
Yeah, I think that the quote unquote Yale model gets viewed first as an asset allocation approach, but upon further depth and inspection, you find that the allocation is part of it, but also so is access, and so is governance. And do you have the right team? Do you have the right stability in the organization? Do you have the right decision makers? And then can you genuinely be long term? I think a lot of the alternative asset classes, if you sort of take the typical performance chart that shows the 10-year annualized by quartiles, and you sort of look at it and go, well, hey, I want to access some of these much, much better returning strategies. Truth of the matter is, frequently, if those relationships don't already exist, you have to kind of delete a lot of the line items in those top quartiles because they're not accessible, which means the overall accessible median actually comes down. And that's where you have to be careful, because if the median doesn't include best performers, the median is often below what you can access in the public markets, and therefore, buyer beware. But implementation is absolutely key. It's not a function of, hey, let's just go invest in, list your favorite groups you'd like to invest with. You've got to have that governance in place that understands what you're trying to get into, and then enables the allocator team to go and to pursue it, and takes a long-term view. I think it's possible today to build an outstanding, best performing private equity program, but I don't think you can do it in 12 months. And I think it's a multi-year, if not perhaps a decade long, to put the pieces in place.
Okay. So you touched on, in terms of the alternative side, a little bit on the real asset side and the private equity side. In terms of absolute return, hedge funds, quant strategies, obviously something that we talk about a lot here on this podcast. I mean, when you're thinking about absolute return and, I guess hedge funds, you've got a whole spectrum of different strategies there, from kind of long short, relative value strategies to directional strategies like trend following and global macro. So what's your model for thinking about the different strategies and their role in the portfolio?
So yeah, I frequently, absolute return is where I started 15 years ago. And then, that was 2007. And within 18 months, learned a lot more about the space. I think if done well, they can be an absolutely fantastic part of an asset allocation. Access isn't as challenging as it is in some of the private market strategies, and the potential for return, while I'd say more moderate, the potential for diversification is pretty strong as well. In a year like this, the CTA strategies and many of those others are performing exceptionally well, and within expectations. I frequently give the advice to students or others and say, hey, if you can join a hedge fund program, you should, even if it's not where your passion is. Of the different asset classes, I've now allocated to basically all of them. It is the most difficult to get right with persistence, and I think that one also has the most potential to diversify. So those types of strategies, for our portfolio, I think the other thing to do is to think about them holistically within your whole portfolio. If you're an organization that believes strongly in active management on public equities, and you have a fantastic book of active long-only equity managers, you may not need long-short in your portfolio. On the flip side, you may believe completely in passive, but you may have the view that because there are now more ETFs than stocks, there's potential and for a number of reasons, with far more passive or index investors, there's more potential for price discovery, and that kind of a structure, long short, can be useful. I think the way that I like to think about it in our portfolio is really a couple of categories relative to total plan. That first category, I'll call it minimal and minimizing systematic exposures. These are strategies such as CTAs, which can either have extremely low correlations or negative. They can really be beneficial to a total plan. And then the other category is, and that first category of minimal and minimizing, you just have to know that these things can sometimes have really episodic periods of performance. You may go for long periods with relatively uninspiring outcomes and then, be followed by them working and punching well above their weight in periods when you need them to, such as 2020 and 2022. The other category I refer to as sort of more moderate beta. These are strategies that are, a 0.3, maybe 0.5 on the upside to public markets and sort of economic sensitivity, but they're far more consistent in their performance numbers. And when you couple that together, at least in a year like this where the Barclays Ag is down 10%, that type of a portfolio can be positive and can be a nice sort of tool in the portfolio. But it's not about owning it as an exposure. Even within those categories of strategies, there is skill and you need to be able to identify it and then implement.
Okay. And you said it's the most difficult, I think it's the element of the portfolio. I think it was that you're referring to the hedge fund absolute return component. Is that it?
Well, none of them are easy, but that one I think is by far the hardest to get right on a consistent basis. We've done so, and I think that's largely because we have a senior team that's been together for 15 years and largely was together pre-GFC, and so those lessons have become institutionalized and carry through to how we make decisions today.
And is that not falling? I mean, what's difficult is it not falling foul of kind of exiting strategies just because they're in a drawdown, or is it do you think manager selection is particularly difficult, or is it that the return profile and the correlations can be variable over time, or what would you say is the kind of the really challenging part of hedge fund allocating?
All of the above.
Yeah. All of the above.
It's,
fair enough.
A lot of it, and I think that I think one of the challenges actually can be solved if you approach it first from the perspective of remembering that ultimately your first assets or risks are the people making decisions. And so you need to make sure that, Excel will tell you, Excel or any quant tool will tell you what has happened, but it won't tell you why, and it won't tell you how they make decisions. It won't tell you what their personal utility curves are in terms of, what they value and how they're going to do things. So I think the quantitative is definitely useful for screening and understanding particular periods but use it as a tool to start to figure out what to ask, not to draw conclusions. And from there, you really have to get to know the skill set of the people and the character of the people, because ultimately, if you're going to be in it for the long game, those aren't decisions that you want to be remaking every 2 to 3 years. Ideally, when we enter a relationship, we have at least a 5-year view on that relationship. And we may have spent, because our portfolio is relatively mature, we don't need to change things all that often. We may have spent a year or 2 years getting to know a team across parts of the cycle, seeing how they make decisions. And then, thankfully we've been able to put together long-term partnering relationships which I think are beneficial for both sides. Because the more you get to know a group, the more you're prepared to understand those periods of underperformance or challenge and evaluate them with fresh eyes and say, is this an internal issue or an external issue? And if it's external, you can be patient. If it's internal, I think you have to reassess.
And I mean, it's interesting. You talked about getting to know the managers, and you said at the outset that's one of the things that you focus on is trying to understand the manager's story, long story or short story, whichever it may be. What are you looking for in that story that is interesting or relevant that might tilt you to say, okay, this is a manager that might be more interesting to learn a bit more about when people talk about their story? Because conscious that everybody has narratives, there's narrative bias, there's all types of different biases, which I'm sure we can get into, that we can be seduced by. But what do you think is relevant to be looking for when you're hearing about the background of a manager?
Well, the phraseology we frequently refer to as outstanding and thoughtful investors. And the outstanding is a pattern of judgment and decision making. And this applies to CTAs too. What's the research process? How do things get into the model? It's not, you can apply this just as well to quantitative as to fundamental strategies. But the outstanding tends to be not a near-term period of strong performance. Outstanding tends to be a long-term history of success and excellence. And what we typically do is it's a lot of case study evaluation. Like, let's go through, it would not be uncommon for us to evaluate a group, and over the course of a 6-month period, at the end of every month, get on the phone, talk about the decisions they made, the performance, the results, and why they made those decisions. And what we're looking for is really good judgment. There's a great quote from Michael Lewis in his book about, I think it's in the book, The Undoing Project. And he says, I'm going to botch this, but it's going to be pretty close. The role of the decision maker is not necessarily to be right, but to understand the odds and play them well. And everything in investing, there's very few times when things are discrete. Everything is a range of outcomes and probabilities around it. So for outstanding investors, the track record is a signal, but what you want to dig into is how do they make decisions, and is there a pattern of really good judgment? And what's the judgment about? Well, the judgment is about what's the potential upside here, what's the potential downside, what are the probabilities? And so the outstanding tends to be how do they make decisions and identify opportunity. And then the thoughtful side of it is, frankly, it's a question of just, are they mindful about risk? Everyone says they are, but once you know what you're looking for in terms of mindfulness about risk, it becomes a lot more apparent whether risk is at the forefront or as an afterthought and how they take it. So we're looking for that combination of both outstanding opportunity identification and also really thoughtful about the risks and likelihoods and how things then get sized and things like that.
Okay. And I mean, you talk about that both from a systematic perspective, quant, and it sounds like those types of things may be easier to evaluate on the discretionary side, arguably, maybe not. But is there a different lens you have to look through for evaluating quant strategies or not? Do you put more emphasis on the data, or is it still very much a focus on the principles, the research process, and how they've constructed that?
I think it's pretty balanced. I think that you can go and visit some of these quant shops and their performance, and then you sort of meet with the research team, and you understand how the ideas get vetted. You see how the ideas compete with each other, how they eventually, with more conviction, get sized up and go into it. And I think that ultimately that even for quant strategies, the people are generating the models, they're generating the research, they're generating what goes into the portfolio, and so that's where you have to start. And we don't have mathematic PhDs on staff and things like that. So a lot of it is the multiple data points over time to build conviction. And I think that you absolutely want to be able to do, in fact, contrary to your point, I think the discretionary is a lot harder from more kind of top, if we're talking sort of more macro strategies, it's far more difficult because it's hard to identify someone that got something right. It's always hard to identify the amount of luck and skill in there. And, using Malbosin's framework of can you lose on purpose? If the answer is no, there's a good amount of luck that is likely embedded. And the systematic is a little bit more, I wouldn't say easy. None of them are easy, but the discretionary is harder because there tend to be far fewer bets that can move the portfolio. And they tend to, it's very difficult. It's very difficult to identify a group or an individual. It's usually more individuals than groups that sort of have a good sense of what are the forward scenarios, what are the likelihoods, and then kind of picking from one to the next, which ones will work out. I think discretionary is probably the hardest to get right over the long term.
And has that influenced your allocations? Have you had less to discretionary because of that? Or is that just something that you live with, that there's a higher range of possible outcomes in that element of the portfolio?
No, it's been very, very difficult. I'd say that we are there are a handful of strategies. We probably say default target size should be 0. And then to the degree that you can find something that has proven otherwise and has done so over multiple time periods and different regimes, then maybe your conviction can go up. But that's a space which is very difficult to do well on any form of consistent basis.
Okay. So thinking about all of that, I mean, in the context of the portfolio construction, then, your hedge fund, your absolute return allocation, is it a balance of presumably of bottom up and top down, or is it more, here's a set of managers that we have conviction they can generate performance and we're going to go with that? Or is it starting from, well, we're going to have an absolute return portfolio, probably, maybe 20% CTA, 20% macro, or 20% long short, 20%. How do you find a balance between the top down and the long and the bottom up?
I'd say that for us, we start with the bottom up because, again, if you're not sure about a group, starting top down and sort of forcing something in, we haven't found that to work. So our approach tends to be, find the groups. And then from a top down, I think we're a little bit, try not to be too clever about it and sort of say, well, you still want, if you can, you want to have diversification by strategy, by space, by thinking, by approach, by geography. But from a bottom up perspective, that has to be there first. And if the particular teams, if you find them, the way ours builds out is you then sort of each category organically fills itself by your selection. And then you create some constraints for yourself around, how much you're willing to have in each space. But we certainly wouldn't see ourselves as forcing anything from a top down. Because again, these are active strategies and it's very people dependent. And you can't, there's not an approach that you can take that on a top down is likely to just satisfy your objective.
Fair enough. And you touched on kind of the challenge of the manager selection and, assessing luck versus skill. Can you fail on purpose? That type of idea. So, I mean, it's something that we've talked to other guests around, is the whole area of behavioral biases in manager selection. So it is, there's a whole array of them that fall into this challenge. What do you think are the things that most obviously come to mind that you have to kind of keep to the forefront of your mind when you're evaluating managers? And then secondly, apart from being aware of biases, what is there anything you can do from the portfolio or investment process perspective to help mitigate them?
So biases first and then approach to mitigating. There's been so much great research on biases that, I almost feel like no matter what scenario you're in, especially if your team, there are multiple active biases in play at the moment and, often competing with each other. But I think the one, if I had to pick a tip of the iceberg bias, my personal opinion is that it tends to be sort of track record is thesis. Performance, I can just point to it and the phrase is true. You can't argue with numbers, but I also don't think numbers tell you the whole truth either. So, that piece of it, I personally believe, and I think we have found that, the performance number is the tip of the iceberg. There's a whole lot going on underneath it that then the tip emerges, and that is what's there. And so I think that one of the biggest biases is just dependence on quantitative analysis as track record is signal is thesis. And I would say, track record is signal. That's possibly true. Track record as thesis is beware, because when things like regime shift or other things happen, all of a sudden you're unlikely to trust your numbers anymore, or you'll be far more sensitive to what could the underlying risks be that would change those outcomes. So, I mean, we could go into, there are so many biases that could be talked about, but that's one that I find tends to be a universal one. And then, if you start out and you have the benefit, I would say, of joining something ahead of a really strong correction, it tends to tear down that bias and perception pretty quickly, because you find out that, like, yes, this was my number, but I probably should have paid more attention to the vol, which showed the whole range, and think in terms of ranges instead of the performance number. So that dependency on quantitative is I think, at least at the outset. I think people can grow out of it over time, but there's a universal element of that. The way that we've attempted to approach it is in terms of being very intentional in our culture and our approach and our process. So, every single prospective investment that comes, every existing investment has at least two sets of eyes and ears that are coverage. And that's, to help people stay balanced and to stay objective about things. And then for new investments, we have a primary team, which is tasked with conducting the due diligence process. And then on top of that, we assign a review team. And the review team includes people from other teams and from other asset classes to provide additional perspective, resources, networks. And it's a little bit of a messy process and sometimes feels disorganized because you've got people from different teams contributing and trying to help. But that said, I'm amazed at how frequently things come in that just help that process, help us diligence it from that different set of perspectives. So one of the ways we've sought to mitigate those biases is a slightly larger group of team that helps review each asset as it comes through or each investment. And then we also sort of try and take a growth mindset about our people. We want people not to be pigeonholed. They may start off in a particular asset class, strategy, or area, but over time we want them to go deep in that space and then also go lateral in other things because I think it gives them better perspective. The topic of, generalists versus specialists, there's no right or wrong answer. I think if you can, to some degree, bring them together, it can be really helpful in decision making.
Yeah, interesting. And from building that back up to the overall portfolio, then, obviously you're saying don't put too much emphasis on the track record. How do you go from kind of that quantitative and qualitative evaluation to formulating some kind of return expectation that you can kind of stand over then at the portfolio level, given that maybe, absolute return is about 15% or so of the portfolio, maybe a bit more. So it's pretty meaningful. Is that based on some kind of perception of a risk premium or an assumed Sharpe, or how do you think about, obviously, as you say, you can probably have a good sense on the volatility, but return expectations setting for alts. How do you kind of approach that?
Return setting for expectations for alts. I do think there's an element, depending on the strategy. I think for sure there's a risk premium element. There's cash, and then you've got investment grade, and then maybe bank debt, and then high yield, and then mezzanine debt, and then pref equity, private equity. As you go through the different parts of a capital structure, you can kind of use a premium-based approach. And then I think in the alts, the other spaces, you do have to default with some degree of, or if you don't default, I don't know how you would do it. But for sure, you can start from the place of, well, what's been the annualized long-term number? Okay, we can look at that. Second, let's overlay that with what's the current environment for that space. I mean, one of my favorite questions to ask managers is simply, if everything works out to your upside case tomorrow, what's the likely return in the portfolio? And, most of them know the answer to that pretty quickly because they've underwritten it. So there's an element of the backward looking, which you can't ignore, but I think be wary of just extrapolating it forward, which is that probably the second bias that's parceled with just the quant is the natural tendency to just take what has happened and continue that trend forward. So I think in the current environment, for some strategies, an increasing or a higher rate environment is a positive for a lot of reasons. But that's return expectations. It's kind of strategy by strategy. I think as an entire asset class, we will start with what has been the longer term result. And truth be told, those tend to be pretty good predictors at an asset class level. On a bottom up basis, though, line by line, I think is how you have to.
Yeah, fair enough. And I mean, the 40-20-40 overall asset allocation, is that something that you would see as being stable over time, over the next 10 years or so? Or if you saw a big shift in valuation one way or the other, would that change? So if equities bounce back and hit new highs and reached ridiculous PEs, would you be saying, okay, now that there's less value there? Or if we saw a big a resumption to the downside in equities and by certain value measures it became more attractive, would that tilt it? Or I guess you're already kind of 37 in public equities versus 40. Does that reflect a valuation view, or how responsive is the overall portfolio to perceptions of value at the asset class and strategy level?
Oh yeah, that's a tough question. I would say that if we had a regime shift that seems to be a structural shift, that would probably push us to more reevaluate. The question of, is it stable for the next 10 years? As we go through our next deep dive into what are we expecting and, what are the potential outcomes of that? I think allocators and investors, you have to be willing and able to reevaluate. For a very long time, our portfolio has been relatively stable, but we've also been in a relatively tight band of regime, largely driven by interest rates. I would say that interest rates are probably the primary factor that would change all of the potential to make change. And that's something that's been said internally in our organization for many years is if we were to go back tomorrow to an interest rate period where, interest rates are 8%, that's going to have really different longer term 10-year implications for asset classes. So I think the way that we try and build it is you can't build it. There's no portfolio that can be built on a permanent basis. That said, unless there's strong reason to believe that the regime has actually shifted, you really need to kind of stick to it. If there's one thing I know, if you want to fail, change your asset allocation on a regular basis because you'll always be chasing either the last opportunity or fighting the prior battle. And so there's far more value to be sort of pick an approach, understand the pros and cons, and demonstrate some persistence.
Okay. So you mentioned that, in terms of cultivating talent and people, you like to kind of get people to go from kind of specialist to generalist. I mean, from your own evolution from being a kind of a hedge fund specialist to moving into more asset allocation and deputy CIO, what do you think has been important from the skill set to be able to do kind of a CIO type role? Do you think having done lots of different types of strategies and approaches is helpful? Or, if you were to kind of outline the ideal path, if there is one, what do you think that would be?
Oh, goodness. I think I would probably start with the mindset, have a growth mindset about yourself. Constantly be seeking to learn. I think to a large degree, my path, I've been at URS since 2007, have been involved in the build out of absolute return, private credit, taking more private equity investments in-house, real assets. If you can, honestly being part of an organization that has a growth mindset about its people is probably one of the key factors. So many organizations, at least from my peers who I talk to, say, it's great that you guys have the ability to grow your people, because for me, I have to sort of posture and change organizations every time I need to move up. And at URS, we've tried to take a really intentional growth mindset about our people, offer a career path. Growing our people is one of our core competencies. And I think that what would I recommend to people? Honestly, I think learn to write. The ability to articulate and communicate complex things in simple manners in written form is really critical. Frankly, I think if you can be part of I think our private equity team will smile if they hear this, but I'll say if you can be part of a credit team, it's extremely useful. I came from the first 10 years as a hobbyist, and then through school as only thinking from the equity lens. And then when I got to URS in early 2008, was assigned to be part of the credit endeavor. The world changes when you see how complex that side of a balance sheet is and how influential it is on everything else that happens. So if I had to say, those couple pieces of advice would be, growth mindset, learn to write, and then also it's really healthy to have a credit lens in your back pocket, because you'll appreciate risk from a different perspective. You'll think about things differently. When our team, it's not uncommon for our team to be looking at something and then, want the credit team to participate in a diligence call, because they will get a whole different set of questions that frequently either the operator or the manager knows, but they may not naturally tend to go there because they're thinking about the opportunity. But that balancing of both opportunity and risk, I think, is critical. If you want to move up, performance is one thing, but having a good view of both sides of the coin helps you along that path.
Fair enough. And I mean, you touched on developing people, etc. And lots of organizations say they do this. So, I mean, what is it that you're specifically doing, you think, that would differentiate URS from other plans and the opportunities and how you develop your investment people?
Well, so to just let's take someone coming straight out of a program, out of university. When they join URS, typically you're assigned to a team, and we have a 3-year analyst program. And there's a specific set of things we are looking for you to develop along that time frame. So not just come in and do a good job, but we have a set of criteria that if you do well along those criteria, you will be given more responsibility, more accountability, and more rope. And from there, we have a senior analyst program, which is also, sort of defined in timeline with again, additional criteria and things that you need to develop. And it's not that you'll be doing it solo. Our job is to grow you. So portfolio managers and senior team members, part of their job is, it's in their job requirements as to grow people, help them develop their competencies. So, it's both a mindset. We talk about it, but systematically it's incorporated into our objectives. It's incorporated into how we, conduct annual reviews, all those things. Because frankly, the more experience and growth the people have, the more it extends our reach, our capabilities, and our potential. So frankly, you make the comment that a lot of organizations pay lip service to it. And, I think that we're not perfect, and a lot of what we have is aspirational, but that I think it's empowering for a brand new analyst to show up with limited experience, be assigned to a review team that's going to look at a new CTA investment and be expected to figure it out along the way and understand it and ask thoughtful questions. I mean, we expect our team, if you're part of a review team, it's not, you're expected to come to the discussion with questions in hand to help the whole team better understand it, and through that, the individual will grow.
Okay, so challenging objectives from day one by the sounds of it. That's we're almost up to the hour. It sounds like a pretty good segue. You've given a couple of kind of ideas there in terms of things that up and coming CIOs should be able to do in terms of writing and articulation and considering the upside and downside, that risk and downside mindset. We always ask guests for any other advice or recommendations, any books that have been particularly influential on you that you would like to share with us and think are worthwhile for people to delve into.
Well, I think, as it relates to advice, there's one thing I think I'd be remiss if I didn't mention, and that is how key governance is to any successful program. Okay. Maybe it happens, but I've never heard anyone say, well, look how poor the governance structure is, but at least the results are exceptional. Maybe that happens. I've never seen that coupled that way. So one comment would be, if you're, moving into a leadership role, anything that you can do to enable the governance and improve the governance, and often that's difficult coming from the bottom up, but governance is so critical to success in these things. URS, we're in an enviable position. I think if someone had to say, what do you attribute success to at URS, first and foremost would be a really strong governance program. There are for sure programs out there that are better, but most of those are outside the US. I think URS has amongst the best, if not the best, model for how to govern a plan like ours.
And in very short, it's probably a whole separate area to get into, but in a couple of minutes, or in very briefly, what would you say is the absolute critical element to a governance structure that adds value?
Some degree of independence and the professionalism of your board. So, and I don't mean that in terms of behavior, but predominantly having investment professionals oversee an asset allocation and oversee a large investment team. At $54 billion, our board is largely investment professionals with decades of experience. That really enables the right kind of discussions about investing. So that would be the first. For the other things, I think, I gave the advice, learn to write. I think that's critical. Some of the other influential things, anything you can read by Charlie Ellis, you should read it. I think his paper, which was written in the early 80s, The Characteristics of Successful Investment Firms, is as relevant today as it was 40 years ago when written. In fact, you read it and it still feels very fresh. But Charlie Ellis, I think, is amongst the foremost investment thinkers. Was a member of the Yale Investment Committee for 10 years and has written a lot of influential things. But his material is fantastic. I think his book, The Partnership, which is about Goldman Sachs, is a good case study in how the tip of the iceberg doesn't show everything that's going on underneath and how those things are all critical. I'd also say that from a leadership perspective, Patrick Lencioni's The 5 Dysfunctions of a Team is an exceptionally good book. And it's, what I love about that book is less here are new things to add to your, day-to-day tasks, and more about let's identify all of the things that create hurdles and just stop doing those things. It's always easier to do less. I'd also say that Hit Refresh by Satya Nadella, the CEO of Microsoft, is an exceptionally good book about constant learning and taking the best of what is and iterating to get better. And then, from there, as far as investment thinkers, my list isn't all that atypical. I think Howard Marks is always great to read. Dylan Grice is probably one of my favorite writers, as is James Montier. And then, outside that, just stay curious. I mean, the only thing I read with any consistent regularity is The Economist, because it really pulls you and it can pull you in so many different directions.
Great stuff. Well, that's some reasonably lengthy reading list for us, but all good stuff. So very much appreciate that, and thanks very much for coming on and chatting to us today. There's a lot of interesting stuff to unpack there, so I think we've learned a lot. So thank you very much. And with that, I'll hand it back to Niels.
Thank you so much, Alan and Jason, for a very insightful conversation where you managed to touch on some really key nuances in the allocation process that we don't hear so often. If I start in reverse order, I love Jason's advice to young people about what they should learn, such as writing. Even if they work in finance, this is key. And I can't tell you how many times I have encouraged my own children to focus on this particular skill. And of course, having a growth mindset is also super important on all levels. It was also very topical to hear Jason mention that interest rates and the level of them would be the primary factor that can prompt a bigger change in their asset allocation. And I think with how the world is evolving, interest rates will be the key driver of change, which of course we also spoke with Edward Chancellor about in a recent episode. I enjoyed hearing about what they consider the most dangerous biases in their process and how they overcome them, and what it really is that they look for in a manager, what makes them outstanding and thoughtful. That's it for this episode. Make sure you go and follow Jason and Alan's work, because as you can tell from today's conversation, it is so important that you understand what is going on from a global macro point of view in order to allocate capital well. And we really look forward to sharing many more of these insights in our series as it continues. From Alan and me, thank you so much for listening, and we look forward to being back with you on the next episode. And in the meantime, as usual, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.